Hi, welcome back to the RebelEngineer YouTube channel. As you have probably witnessed since the start of 2024, tech companies have been laying off the employees en masse, and yet their stock prices have been struggling to recover. In today's video, I'll be talking about the reasons why I believe tech stocks will be stagnant in the next decade when adjusted for real inflation, not the fake inflation that the Fed is pushing out. We'll be discussing the real inflation rate in another video, but essentially, the Fed calculates inflation by replacing the price of 1 pound of steak before the pandemic with the price of 1 pound of burger after the pandemic when they talk about inflation in beef price. In other words, real inflation in the US is much higher than the 3-point-something% that the Fed is pushing. As you may know, tech stocks have been in a big slump in the past couple years. Yes, there have been whispers of positive signs, but overall this does not give me confidence at all. And I still strongly believe that it will take tech stocks and tech companies many more years to recover. And I will give you some of my reasons why I think this may be true. The first reason is that there is currently a long-running recession that was born from the COVID-19 pandemic, and the fact that the United States had to print money. And here I can show you all the money printing since COVID. We have printed in total $5.2 trillion, and World War II cost $4.7 trillion. Right, so all-in money printing total $13 trillion. 5.2 for COVID, 4.5 trillion for quantitative easing, and 3 trillion for infrastructure. And it's a year, mountains of money cause inflation. And this is on the Nasdaq.com website. And here in this article, you can see that all this money printing, 4.2 trillion. Biden pumps fiscal policy. Yeah, we printed tons of money. COVID relief prints $5 trillion. Pre-COVID, $4.4 trillion. Post-COVID, $12 trillion. So yeah, in total, we have been printing $13 trillion for the entire COVID pandemic. Maybe almost 3 times, 2.5 times World War II, right? So that's a huge number. This global recession has only been prolonged due to the rising geopolitical tensions and disputes in the last couple of years, with no signs of resolution anytime soon. This global recession has led to massive layoffs in tech and massive outsourcing. Companies are laying off more and more staff and then look to outsource their workload. According to Layoffs.fyi, the total number of people laid off in tech in 2023 was around 260,000. And in 2024, this year, there have been around 40,000 people laid off in tech so far. These are massive numbers, and it looks like it is only increasing by the minute. There's a huge recession, and companies are looking to cut costs wherever they can. But this doesn't inspire confidence at all. And all of these massive layoffs will just make people in the workforce market grow wary of joining tech companies in the future. And if there is a recession, then of course we cannot expect anything too promising from the performance of these tech companies and their stocks. Now, the second reason why it might take a decade or so for tech stocks to recover is that these massive layoffs are dangerous, short-term moves that really erode talent and brain capital build-ups in the long run. Companies are really sacrificing their long-term development for short-term solutions to their problem. All the staff and workers that all these companies have taken so long to onboard, then train, then develop into highly qualified personnel, now are all laid off. These companies then pivot to outsource talents to save on cost. But what they fail to see is that these outsourced talents can actually provide them the same level of results that people who have been with the company for years and understand the way the company works on a deeper level can. These are the people who big companies should actually be investing their capital and time into, because they are the ones who will develop and grow the company, people who actually care. Instead, companies are choosing to ignore this long-term vision. And furthermore, all these mass layoffs will increase stress and anxiety levels in the employees who do manage to stay at the companies, making them fearful for their own positions and rendering them unable to perform their work at 100%. Here I can show you an article from April last year on Fast Company. It said, leaders, your mass layoffs may have an unintended side effect that hurts the company bottom line. Yes, in the short term, it boosts the stock price and it helps with short-term profits, but in the long run, it will actually hurt employees' morale, burning them out, and really affect the long-term outlook of the companies. A new study shows that layoffs may result in companies losing workers they want to keep around too. I think in the long run, when you keep laying off people, the people who remain will start to look elsewhere, in other places that provide more stability. So that essentially is what happens, right? And also, believe it or not, many big tech companies now just look for startups to acquire to ramp up their AI efforts. And then they cannot execute because their fiduciary duty essentially destroys their ability to compete because they have to prioritize shareholders' short-term profit over the long-term strategic moves. This is a concerning look at the overall long-term development of these companies and of course a concern for their long-term recovery. The third reason why I'm not confident about a recovery of tech stocks in this decade is that the AI revolution that all these companies are obsessed with is so expensive and difficult to fully adopt. AI is in fact a long-term game that is very capital intensive. Data collection and storage solutions, two things that are essential and vital to AI, will cost these tech companies an arm and a leg. AI sure is promising and enticing, but the reality is that these big tech companies are really struggling to recoup profits from their AI products because the costs required to produce, develop, and train these AI models are so high. Here I can actually show you in an article. AI cost curve have big tech losing money. Yeah, so essentially AI is a money loser because it is so expensive to run. It looks cool and it does improve people productivity in certain ways, of course, like OpenAI, for example. I use ChatGPT a lot while I was searching for a job, but AI is definitely a very heavy and very capital-intensive investment. And it's kind of hard to move beyond excitement to adoption because the cost to actually grow the AI will be passed down onto the consumers, right? Or maybe the businesses that actually use the AI engines, and it will end up in, increasing costs for other types of businesses that want to adopt AI. So essentially, it is a cost to the entire tech industry as well as other industries that want to adopt AI. We can take, for example, Microsoft with their Bing AI chatbot, which runs on OpenAI. Analysts have estimated that the chatbot needs at least $4 billion of infrastructure just to do its job. And the reality is that OpenAI spends up to $700,000 a day and is increasing day by day to maintain its infrastructure and keep up with its server costs. And in 2022, the company has recorded total losses of $540 million. A recent study by DG economists titled The Growing Energy Footprint of Artificial Intelligence, published on October 10th, 2023, showed that by the year 2027, AI servers would be responsible for as much energy use as the whole country of Sweden, an entire country. That's a crazy large amount. The fact of the matter is that AI is still in its infancy, its developmental stage. Companies are obviously trying to draw up interest from the public for their products and gain more customers. But the truth is, it is very, very hard to crack profits from this AI revolution as of right now. And the thing is, if we don't achieve artificial general intelligence, AI will definitely become a bigger money black hole than it is now. Some would say a massive money super black hole. AI improves productivity, yes, but at a huge cost. On the other hand, if we do achieve artificial general intelligence, it will destroy so many jobs that regular consumers would probably have no income left to spare to purchase goods and services, which will be an even further hit to these tech companies. So now you can see that while this AI revolution is very promising, it is so expensive and difficult to fully adopt that it might just hurt the recovery prospects of tech companies and tech stocks in general. Now, the next reason why I think tech stocks might take a long time to recover is an increase in protectionism policies, especially in the US. Countries are becoming so scared of other countries that they are keeping everything covered, not sharing anything with each other and raising barriers, especially in the tech industries. Like, for example, so many countries have banned TikTok. Everyone is afraid that TikTok will spy on you or steal the data, so everyone was quick to jump on the ban TikTok movement. But all these protectionist policies will only hurt the tech industry in the long run. Everyone is so focused on protecting their own interest that they will be closing off themselves to the world. Nobody is going to exchange information and share knowledge, which will make innovation very, very slow. In the age of AI, everything moves fast. If you are slow to adapt or evolve, you will fall behind. These protectionism policies will really hurt the tech industry because when you close yourself off from certain markets, it will make your evolution and growth so much slower than it could have been. Another way that protectionism hurts tech is the disruption of supply chains. It can slow down or even impede many of these tech companies' key supply chain where they source their components. These obstructions are likely to increase costs, delay production times, and cause supply shortages for all industries involved. Protectionism also limits companies' access to high-quality foreign talents, technologies, and intellectual property. Countries are trying so hard to close themselves off because they're so scared of competition and rival countries. But then these policies will ultimately hurt tech companies in the long run. Reason number 5 why I think it will take another decade for tech stocks to recover is the aging population, particularly in the United States. The Western population and the US population are aging fast. The US median age has now jumped to nearly 39 years old. People in the United States are growing old fast. From 2010 to 2020, the share of US residents aged 65 or older has grown by more than a third, which is the recorded fastest rate of increase of any decade in 130 years. And in the opposite direction, the share of children decline. This means that there are more and more old people and fewer young people. There are more and more old people because of advances in healthcare and nutrition, which is good, and a higher quality of life, which is also good. And there are fewer and fewer young people because women are now choosing to delay having babies until later in their lives, because of educational reasons, career reasons, or economic reasons. Experts have been saying that birth rates never really recover following the Great Recession of 2007-2009. So the main drawback of this aging population is that there will be a reduced pool of qualified workers in the future when all these old workers retire, because the birth rate will be slower, because fewer and fewer people are having kids. Who are going to replace them? Tech companies will have a hard time replenishing their workforce in the future. And there is also the problem that there will be less and less consumption in the long run, which further hurts the tech industry. So we can all see the fact that the population is aging so rapidly is just causing a snowball of problems. First, companies will find so hard to replenish their workforce. Then we'll see a decrease in consumption rate in the long run. Then everything will cost more to produce. And then everything will be more costly to the consumers, driving down consumption even further. This is why it will be so tough for tech stocks to recover when adjusted for inflation if this continues. Overall, this bleak outlook will be a vicious cycle in which the recession makes people not wanting to have kids. People not having kids cause problems for the economy like we have talked about before, which will increase the life cost and make people buying power even weaker. And then so on and so forth. And then there is also the problem of corruption in the tech industry that we should also talk about. Big tech companies have influential power, and a big piece of the market often have a say in policies that affect the tech industry and other companies. The more money and power they have, the easier it is for them to use their pulling power to influence policies to be more favorable to them. How do the tech giants use this power? Well, the first thing is to scoop up all the best new startups thanks to their influence and money. One famous example that we all know is Meta scooping up Instagram and WhatsApp in 2012 and 2014 respectively. And then the startups that manage to survive the scoop and continue on will face competitive landscape of a tech industry dominated by the Big Seven, aka the Magnificent Seven. The Magnificent Seven have created an ecosystem in which they are the kings. They create server clouds, app store, app networks, venture firms to make the smaller companies and startups depend on them and have to pay them large amounts of money just to keep operating. For example, you can see how Snap Inc. has to pay Google $400 million a year over a duration of 5 years just for cloud hosting. This just leads to the erosion of innovation and startups. Because the big guys are creating so much unfair advantage in the industry, they are doing everything to keep their seat at the top. And now they are going out here again trying to find startups to purchase, but there are none. Why? Because they have already squeezed them out through backdoor means and regulations. So what can you do? So you can see how there are so many reasons and implications why it is going to be really difficult for tech companies to recover and grow in the next decade. There are so many obstacles and self-sabotages, which is why I am not confident about the outlook of tech stocks at all when adjusted for inflation. So what can you do in the face of all these? If you are an engineer in this market, forget engineering. Focus on side hustles. From now on, engineering should be your side hustle and your side hustle should be your main job. Personally, I've talked about how I've been trying to focus more on producing media and get out of engineering. I have mentioned in other videos how a lot of people have been trying to do this too. It is something to consider. If you are an investor, you should invest in companies that are arms dealers for the AI industry and other tech industries. For example, cloud computing providers, chip manufacturer, software development platform, data annotation, labeling service, or algorithmic trading platform. Remember that this is not investment advice, but it's just my personal opinions. The Magnificent Seven will certainly be the mediocre seven if they are not being careful. But even becoming an arms dealer for the AI industry could be risky because you could be facing stiff competition from China, so you may never know. So yeah, those are all the reasons why I believe tech stocks will take another decade or so to recover. What do you think? Do you think they will recover or won't recover? Can you think of some reasons that I may have not included in these videos? Please let me know down in the comment section below. Thank you for watching. See you in the next videos. Bye bye.